$100,000 managed with the right framework is genuinely enough to remove the necessity of work from your life forever. That is not a motivational slogan. That is a logical conclusion. Jim Simons built Renaissance Technologies into the most successful hedge fund in human history. His medallion fund averaged returns of 66% annually before fees for over 3 decades. He did not accomplish this by being lucky, by having insider information, or by following the crowd. He accomplished it by treating financial markets the way a scientist treats a laboratory, with discipline, with pattern recognition, and with an almost ruthless commitment to removing emotion from the equation entirely. This video is not going to tell you that money is easy. It is going to show you how Simons thought about $100,000 and why, in his framework, that number is not a starting point. It is a launch pad. The first lesson is about what most people fundamentally misunderstand about capital. Most people look at $100,000 and see a number. Simons looked at capital and saw a system waiting to be activated. The distinction sounds small, but the consequences are enormous. Consider someone who spends their career working hard, finally accumulates $100,000 in savings, and then stares at it trying to decide what to do. They feel pressure, they feel fear, they worry about losing it. And because of those emotions, they either leave it sitting in a low-yield savings account or they make impulsive, emotionally charged decisions that erode it over time. Simons observed this pattern repeatedly, not just in amateur investors, but in highly intelligent professionals who simply had never been taught to think about capital as a living, working system. Here is the core principle Simons operated from. Money that is not working is money that is quietly disappearing. Inflation is not passive. It is an active force reducing the real value of your capital every single year. If inflation runs at 3% annually and your money sits idle, you are not standing still. You are moving backward. Over 10 years, that $100,000 loses roughly 26% of its purchasing power while sitting completely untouched. Simons understood this not as a financial concept, but as a physical reality, like entropy in thermodynamics. Systems left unmanaged deteriorate. The mindset shift Simons embodied was simple but transformative. Capital is not a possession to be protected. It is a resource to be deployed. Every dollar has the potential to generate a fraction of a return, and those fractions, compounded over time, are what separate people who work until they die from people who stop needing to work at all. When you begin to see your $100,000 as a system rather than a sum, your entire decision-making process changes. You stop asking, is this safe? And you start asking, what is this producing? That shift alone places you in a completely different category of financial thinker. The second lesson is about the single most powerful force in all of finance, which is compounding, and why almost nobody actually uses it correctly. Simons was not just aware of compounding. He was almost philosophically devoted to it. He understood something that most investors intellectually acknowledge but emotionally ignore. Compounding does not reward urgency. It rewards patience and consistency above almost every other variable. Here is a story that captures this principle without requiring any financial background to understand. Imagine 2 people, both starting with $100,000. The first person is aggressive. He chases high returns, moves money frequently, reacts to news, and averages about 14% per year before accounting for taxes, fees, and mistakes. The second person is methodical. She builds a diversified, low-friction portfolio, rebalances occasionally, keeps costs minimal, and averages 10% per year consistently without interruption. After 30 years, the first person ends up with approximately $300,000 after accounting for the friction his activity creates. The second person ends up with just under $1,700,000. same starting point. Dramatically different outcomes. The only variable is consistency versus noise. Simon saw this play out at scale. He understood that the enemy of compounding is not low returns. The enemy of compounding is interruption. Every time you panic sell, every time you chase a trend, every time you restructure your portfolio based on emotion, you interrupt the compounding cycle. You reset the clock. And in compounding, resetting the clock is catastrophic because the majority of the growth happens in the later stages of the curve, not the early ones. The practical implication is this: $100,000 compounding at 10% annually becomes over $1,700,000 in 30 years. At 12%, it becomes nearly $3 million. These are not lottery numbers. These are the outputs of a consistent, patient, mathematically sound process. Simons did not think of returns in terms of excitement. He thought of them in terms of trajectory. Where does this line lead if I do not interfere with it? The answer, in almost every scenario, is somewhere most people never reach, not because they lack the capital, but because they lack the discipline to let the process run. The third lesson is about risk and how Simons redefined it in a way that most people have never considered. The conventional understanding of risk is emotional. People think of risk as the probability of losing money, and they experience it as anxiety. They avoid risk the way they avoid physical danger, through instinct and discomfort. Simons rejected this entirely. In Simons' framework, risk is a variable, not a feeling. It is measurable, manageable, and in many cases a tool rather than a threat. The goal is never to eliminate risk. The goal is to understand it precisely enough that you only accept risk when the expected reward justifies the expected loss. This is the foundation of how professional investors and quantitative funds think, and it is radically different from how most individuals approach their personal finances. Think about it this way. Crossing a street is risky, but nobody refuses to ever cross a street because the risk exists. Instead, they look both ways, assess the traffic, and make a calibrated decision. The risk does not disappear, but it is evaluated and managed. Simons applied this same logic to every single financial decision at a scale most people cannot imagine. Here is where this becomes directly applicable to $100,000. Most people treat risk in binary terms. They either avoid it entirely, which means accepting guaranteed inflation losses, or they embrace it recklessly without understanding what they are actually accepting. Both extremes are forms of financial ignorance. The intelligent position is in the middle, building a portfolio where the risk profile is consciously designed rather than accidentally inherited. Simons would look at a $100,000 portfolio and immediately think about allocation. How much exposure to growth assets generates the trajectory I want? How much stability do I need to ensure I do not interrupt the compounding cycle during a market downturn? How do I structure this so that a 30% market crash does not force me to sell at the worst possible moment? The answer to those questions is different for everyone, but the process of asking them is universal. Risk is not something that happens to you. It is something you choose and calibrate. The moment you internalize that principle, you stop being a passive participant in your own financial life and start behaving like an operator. The fourth lesson is about what Simons called the cost of wrong thinking, which in practice means the hidden financial damage caused by biases that most people do not even know they have. Simons was fascinated by why intelligent people consistently made poor financial decisions, and through observation and analysis, he repeatedly found the same culprits. The first is what psychologists call loss aversion. Humans feel the pain of losing money roughly twice as intensely as they feel the pleasure of gaining the same amount. This asymmetry sounds harmless until you realize what it does to investment behavior. It causes people to hold on to losing positions far too long because selling means admitting the loss is real. It causes people to sell winning positions too early because locking in a gain feels safe. The net result is a portfolio that accumulates losers and eliminates winners, which is precisely the opposite of what generates long-term wealth. The second bias is recency bias, which is the tendency to believe that whatever has been happening recently will continue to happen. When markets are rising, people feel confident and invest more. When markets are falling, people feel afraid and sell. This pattern, which is driven entirely by emotion and recent experience, causes most individual investors to buy high and sell low, which is the most reliable way to destroy wealth that exists. Simons neutralized these biases not through willpower, but through systems. He built rules-based processes that removed human judgment from the moment of decision. If a position meets criteria X, it is held. If it meets criteria Y, it is exited. The human being is not consulted in that moment because the human being cannot be trusted in that moment. That is not an insult. That is simply an accurate understanding of how minds work under financial pressure. For someone managing $100,000 personally, the translation of this principle is straightforward. You build your strategy when you are calm, rational, and thinking clearly. You write it down, you define your rules in advance, how much you invest in each category, what conditions would cause you to rebalance, what percentage decline you can tolerate before adjusting your allocation. And then, when the market does something dramatic and your emotions spike, you consult the rules, not your instincts. Simons understood that the most dangerous investor in the room is almost always the most emotional one, regardless of how intelligent they are. Intelligence without discipline is just a faster path to the same mistakes. The fifth lesson is about the concept of passive income architecture and why Simons saw it as the true goal of capital deployment. Most people think about investments in terms of returns. Simons thought about them in terms of structure. The question is not just how much does this grow, but what does this system eventually produce on its own without my active involvement? This is the philosophical heart of financial independence. The moment your assets generate more income annually than you require to live, you have crossed a threshold that completely changes the nature of your life. You no longer trade time for money. Money works, and you direct it. This is not a fantasy. It is a structural outcome that follows logically from consistent capital deployment over time. Here is how Simons would frame the $100,000 question in terms of this structure. A portfolio of $100,000 generating an average annual return of 10% produces $10,000 per year. That is not enough to replace most incomes on its own, but it is not meant to. The strategy is not to stop here. The strategy is to use this as the foundation of a growing system. If you reinvest those returns rather than withdrawing them, your base grows. As your base grows, the same 10% produces more absolute dollars. At 200,000, it produces 20,000 per year. At 500,000, 50,000 per year. At 1 million, 100,000 per year. The numbers scale with the base, which is why the early years of building the system are about growth, not withdrawal. You are building the engine before you start running it. Simons also thought carefully about the relationship between yield and growth within a portfolio. Some assets produce income directly, like dividend-paying equities, real estate investment trusts, or bonds. Others produce growth through price appreciation. A well-designed portfolio for financial independence balances both. You want assets that are growing your base and assets that are beginning to throw off income, so that over time, the income stream becomes thick enough to sustain your lifestyle without requiring you to sell the underlying assets. This architecture takes time to build, but it is entirely achievable starting from $100,000. The people who never reach it are not the ones who lack the capital. They are the ones who never designed the system. They invested reactively, withdrew when markets were down, celebrated when markets were up, and never thought about what they were actually building. They treated investing like a game instead of treating it like engineering. Simons was an engineer of financial systems. He did not hope for outcomes. He designed the conditions under which certain outcomes became statistically inevitable. That distinction between hoping and engineering is perhaps the single most important mindset shift this channel is trying to convey. The sixth lesson brings everything together and addresses the question that most people avoid asking because the honest answer requires uncomfortable self-examination. The question is this: if $100,000 managed correctly is genuinely enough to set someone free, why are so many intelligent, hardworking people still financially dependent after decades of effort? Simons had a direct answer to this. He observed that most people optimize for the wrong variable. They optimize for income rather than assets. They focus on earning more rather than on converting what they earn into a growing system. A person earning $200,000 a year who spends $190,000 of it is financially weaker than a person earning $60,000 a year who converts $20,000 of it into capital every single year. The first person has a high income. The second person is building a machine. Simons also observed that most people suffer from what could be called financial short-termism, which is the tendency to evaluate every financial decision based on its immediate impact rather than its long-term trajectory. Buying an expensive car feels good now. Investing the same money feels abstract and distant. The brain weights the immediate reward far more heavily than the future one, which is why discipline has to be structural rather than motivational. You cannot rely on feeling motivated to invest. You have to build systems that invest automatically before the money's available to be spent emotionally. The practical implementation of everything discussed in this video comes down to 5 commitments. The first commitment is to see your capital as a working system and never as a passive possession. The second is to protect the compounding process above all else, and to treat consistency as more valuable than excitement. The third is to understand and design your risk deliberately rather than avoiding it entirely or accepting it blindly. The fourth is to build rules for your investment behavior in advance and to follow those rules during moments of emotional pressure. The fifth is to think in terms of architecture, specifically about what kind of income-producing system you are building and what it will eventually produce independently. None of these commitments require genius. None of them require access to sophisticated tools or exclusive information. What they require is a willingness to think with precision, to be honest about your own behavioral tendencies, and to treat the growth of your capital with the same seriousness that a scientist treats an experiment. Simon spent decades demonstrating that markets are not random in the way most people assume. There are patterns, there is structure. And the people who find that structure and operate within it consistently, patiently, and rationally are the ones who end up in a fundamentally different financial position than everyone around them. $100,000 is not a finish line. It is not a lottery ticket. It is the beginning of a compounding system that, if treated correctly and left to run, has the mathematical capacity to produce enough income to remove the necessity of work from your life permanently. The timeline depends on the return you achieve and the discipline you maintain, but the destination is not uncertain. It is a logical outcome of a logical process. Before you move to the next video or close this tab, take 30 seconds and do something that Simons believed was one of the most underrated habits of high-performance thinkers. Translate abstract ideas into concrete personal commitments. So, right here in the comments, write one sentence that describes specifically how you are going to apply the main idea from this video to your own financial situation. Not vaguely, not generally, but specifically. What are you going to do differently starting now? Write that sentence below. And if this way of thinking about money resonates with you, hit the like button. It tells us that this kind of content is worth building more of, and it helps other people who think this way find their way to this channel. Let us close with a summary that is worth keeping. Capital is not a possession. It is a system. And systems that are well designed produce predictable results. Compounding is the most powerful force in finance, but it only works if you protect it from your own impulses. Risk is a variable to be calibrated, not a feeling to be avoided. Your biases are more dangerous to your wealth than any market condition, and the solution is rules, not willpower. Financial independence is a structural outcome that follows from deliberate design, not from luck or income alone. SIMONS did not build one of the most extraordinary financial track records in history by being smarter than everyone else in the room. He built it by being more systematic, more honest, and more patient. He understood that the market does not reward the most emotional participant or the most excited one. It rewards the one who has thought most clearly about what they are doing and why. $100,000 in the hands of someone who thinks this way is not a modest sum. It is a foundation. Treat it like one.